All right, guys, today we're talking to Roderigo McKinley. He is one of the industry's most advanced token economic designers and creators, economists. And as you know, if you're following my channel, that this year I really want to drive home to you the significance of understanding token economics and why they're important, and why, if you're trying to make money in the industry, that you need to pay attention to this. We get a lot of insight from Rodrigo, who has been doing token economic design for about 4 years now, and prior 10 years of economic experience doing quantitative modeling, has worked on mergers and acquisitions, have worked for different banks and financial analysts, and is even a CFA, and bringing all that talent, skill set, and knowledge into the crypto space. We find his work incredibly valuable and very, very interesting. And importantly for you, this is knowledge that you need to have in order to make the best decisions about your investments and the things that you're doing in this space. Keep in mind, this is not financial advice, but we do go into things in this interview about vesting schedules and what does it mean, fully diluted valuation versus market cap. Why does tokens exist? Are there different token models, from utility tokens to security tokens? Things that we need to pay attention to when fundraising or assessing a project for due diligence. We talk about things like regulatory standards that we would like to see in the industry, where we think the industry is failing, where we think it's going quite strong. This whole interview is jam-packed with knowledge bombs throughout the entire thing. This is probably one of the most valuable pieces of content that you can watch in your crypto career. So I'm very excited to show this to you guys, and I am certain that you will gain a tremendous amount of value from it. So make sure you watch it to the very back, and let me know in the comments what you guys think. This is part one of a multi-part series of token economics. As we scratch the surface today, we will go in more granular detail in the future. Let me know in the comments what you found interesting, what you have questions on, what you'd like to see more of, and what you would like us to cover in future token economics series. Stay tuned, guys, get some popcorn, and let's dive into it. What is the difference between a project that has 17 billion tokens and one that has 5 million tokens? Like, how do people look at that?
Yeah, so this is a great question, right? Because we're so used to thinking that stuff has intrinsic value, that more of it means that we have more value. But actually, it's a red herring to think about it in this way. What you need to look at is something that's called the market cap, which is the number of tokens times the current market price of all of those tokens. That's a really simple thing to do. It's just a multiplication. And then, for example, when the current market cap of Bitcoin, which is the number of Bitcoin in circulation, not the final supply, but that are currently in circulation, you multiply that by the Bitcoin price, you get about 470 billion US dollars. And that's telling you that all the Bitcoin that's around at the moment is currently being valued at 470 billion. And once you have that, that allows you to put it into some kind of context that allows you to compare it to other things. So, the value of all gold today is around $12 trillion. So if all the gold that's above ground is $12 trillion and Bitcoin's 470 billion, how do we make sense of that value differential? Or how do we make sense comparing it to something like Apple, which is valued at $2.4 trillion? So I think the market cap is a very important place to start when you are beginning to explore questions of value and whether a valuation is realistic.
With that being said, is it realistic that something like Dogecoin goes to $10?
Is it realistic? It's possible. We were working together when the whole GameStop thing was folding, right? And I think that was really exciting to see what, community spirit could do. Even to this, and to take another example, a lot of financial analysts absolutely hate Elon Musk because Tesla as a business is performing really poorly, but the man has so much star power that he raises, he carries the price of his equity on his charisma. So yes, if everybody woke up tomorrow and said, Doge is worth $10, it's possible. But is Doge being used? Where does that $10 value come from? In the example I just gave, it's because everybody has decided they're going to do something. They're going to coordinate on something. The value of all a dollar as a comparison, because it's actually a currency, is that so many people accept dollars as a form of payment. I can go get a haircut. I can go buy oil. I can go take out a mortgage. I can go buy a plane. There are all these kinds of things that I can do with those dollars, and that is is partly one of the things that gives it its value. So the case for Doge is not there yet. It would be much harder to see how it would embed itself into the economy that extensively from where it is today.
It would put it at a $1.385 trillion market cap, which is possible, right? It is possible if Elon went to all of his other homies and gave them a bunch of Dogecoin and said, hey, let's all accept Dogecoin and let's really try to dominate. I mean, it could happen if they really made. And then also you can look at, for Dogecoin, for example, I'm just pulling up the numbers here. It says that the current circulating supply is 138 billion and some change, and there's no max supply. But it doesn't mean that. Maybe now a good example is, okay, so we know now, one, current market cap, and then how does that relate to fully diluted valuation, and what do people need to be careful of there? What could happen, let's say that sometime into a token's life cycle, maybe it's a year or two down, and they start to realize that maybe the economic model can be better. And so a community makes a proposal and does some shifting around, maybe increases the burn rate or increases the amount that people are required to hold to do a certain thing. And so, I guess maybe, that market cap to FDV, and then does the FDV market cap always remain constant and true? And how can a project maybe that's already launched improve their model?
Yeah, tying to some of the stuff we were talking about in the preamble, just about how much Bitcoin sort of set expectations and framing around what digital assets, what crypto assets are. The fully diluted valuation is a metric that is really closely tied to a token design where there is some maximum supply. That's the only kind of token where that measurement without any further information as makes sense. Where we have a token which through some kind of mechanism starts off with a certain number of tokens and eventually grows to a larger number of tokens. And then when it hits that max supply, it's not going to grow any further. So what the fully diluted valuation allows you to do, remember the point of the market cap was allow us to say, if we take all this stuff together, how much is it worth at the current market price? That's the number we get when we take all the stuff that's around today, the circulating tokens, the circulating supply. Now, if we know that the circulating supply is not the maximum supply is going to arrive however much time in the future, then we can ask a different question. We can say, okay, well, once all that supply is in the market, if the market is still valuing it at the current price, or what would the valuation for all that circulating supply be, that maximum circulating supply? If we came to something that's bigger than the size of the entire world economy, well, we'd hold up. That doesn't make sense. How can this thing, once it's all out there, support a valuation? And it won't support a valuation. What will happen is that the price is going to come down, and then all the number, the market cap will be something more reasonable, something that makes sense. Now, the reason why that matters to you as an investor is you're not holding the entire bag. You're holding tokens. So if when the entire supply releases, the only way it can adjust to a reasonable market valuation is by the price falling, that means you're not making good returns or you're making losses on your investment. So that's a good way of thinking about whether in the long term the token's going to hold its value. The reason why I said it only makes sense in a token that has a limited maximum supply is if you have a token that's inflationary, that says, okay, in the long run, we're still going to be minting tokens at a rate of, 5% per year. Well, there is no fully diluted valuation. If that goes on into infinity, your fully diluted valuation is infinity. But I do think there are meaningful concepts, sort of like where you say the fully diluted valuation 10 years out, 20 years out, 30 years out. But this is now getting into detail. So yeah, fully diluted valuation makes sense mostly in terms of tokens with fixed supply, or to evaluate, some release of some initial genesis supply. And your second question was about improving things.
Yeah, it was about improving economic models post-launch. So like Ethereum did, for example, right? Ethereum didn't have a great economic design the majority of its life until recently, and then they improved it quite a bit, right? They decreased the inflation quite a bit and then introduced burning as well.
I think, this is something that's always struck me a little bit odd about the way we decide vesting schedules when we set supply tokenomics for a new project. I mean, are you telling me if you go to Dragon's Den and you pitch and you're in front of Trump or whoever it is in the US version of the series, and you win them over and you have this beautiful budget. You start up this business and then you find it's all different. Like all of your beautiful planning goes out through the window. And in crypto, we're saying, no, this is an immutable contract. You have to live, you have to run your business by the budget that you set for it before it even got running. That doesn't make much sense. That's unrealistic. Now, that also misinterprets the way this stuff is meant to function. It's meant to tie your hands behind your back enough so that if you do need to make changes, you then need to go up in front of your community and say, hey, we're going to make some changes. We've been on a journey. We've made this much progress. We understand our business model that much more. It forces the project owners and operators to be accountable to their stakeholders, because everybody's going to know when you recut your tokenomics or when you change the rules, and it forces you to be upfront about that. So you're not going to get the business plan right, and I think there should be more transparency about that learning process, or the fact that things are going to change as you learn, right?
So let's go back to the vesting schedules, because this is always a really interesting topic that comes up, and I don't know that, especially for project founders who are listening to this, and I have my opinions. I'm curious to hear yours about the kind of, I don't know if it was the ethos or values when it comes down to investors liquidating or taking profits on their investments. And the way that I look at it is that almost always, unless you have a huge A16Z or Sequoia come in who wants to lead the round and they want to set the rules of the vesting, most of the time, 99% of the time, projects, they're the ones creating these vesting schedules. But we always hear, and there's a general sentiment that if investors are selling their tokens, that they don't believe in the project anymore. They're not long-term bullish, and a lot of investors will get a lot of flack for selling tokens. And so, in my opinion, there's a lot of reasons why this isn't the right way to think about this. But I'd like to hear your opinion on it, and then maybe an explanation about why vesting schedules exist and why is it important that we pay attention to them.
Yeah, this is really complex and rich area for discussion. I think it's unfair to say, like, investors are in the business of making a financial return. I don't think it's fair to say that, to hold them to any other objective. Now, where things start coming apart is that a lot of things have come. What we thought was a great instrument for aligning interests ended up revealing that certain interests can't be aligned. That you have these different actors, and their interests are going to be opposed, even though they are all using the same token. So one of the reasons why we have problems here is that we're using utility tokens to raise capital, and a utility token is a token that's a working asset in the economy, in your project in some way. And if you're using that same asset to raise funds with, you're now bringing on board a bunch of people, a bunch of economic actors whose motivations have nothing to do with the operation of the project or the delivery of its product or service. It's to make a financial return. And by them seeking out that objective, they are disrupting an economy. But that's just what they're meant to do. So actually, one of the ways you can sort of like sort this out is saying, well, actually, investors, we shouldn't be fundraising with utility tokens. We should give them something that's much more like a security. Now, why don't we do that? Because nobody wants to issue securities, because there's so much regulation and so many costs involved with that. So paradoxically, the wish to sort of like escape regulatory costs and burdens, I think has led us to fundraise with utility tokens more often than is good with us. But there's other ways we can solve it as well. I wonder whether it would be possible to migrate to, if you are going to fundraise with a utility token that's a working asset in your economy, well, maybe we could start looking at contracts that have more controls on them. Say the tokens could vest in a wallet that not only is subject to deterministic time-based vesting schedules, but also say, okay, you're allowed to liquidate when there's a certain amount of volume in the market, or when certain other milestones have been successfully obtained. But we're not going to move to that until those kind of terms become sellable. And at the moment, the current standard is just like to have this, time-based vesting schedule, which only does so much to control sell pressure, because if a project's doing well, the investors don't sell the tokens that are vesting, but then suddenly things start going sour. They still have all those tokens that have vested, and then there's no control over what they do at that point, and they're able to act in their own interest and compromise the project because of the way this investment asset is related to how it's being used. So
do you think that, let's say that you have a huge investor who's holding like 4, 5, 6, 7% of your supply, and for whatever reason they don't like you anymore, and your tokens was at $10 and now it's at 85 cents after these guys unload their whole bag in 2 hours?
yeah.
Do you think that compromises the project? Because the way I think of it, and I haven't thought about it in detail, so very much looking forward to your opinion, but if the economic model is sound and that the thing that you've built is still providing value for people the same way it was before, and the only thing that's changed right now is the price of the token, you have essentially, if people are really bullish, you have this huge buy the dip opportunity where the price could come right back up. Or they were holding so much that, maybe that, only some people buy the dip on speculation and it takes more time. Maybe it's just a setback more than a true catastrophic Armageddon event.
I think it really depends on the project. In so many cases, the price of the token is integral to the value it provides users. And that kind of disruption, coupled with, fear and reactions to that, can kill a project, not because it's a bad project, but because the market event ends up just killing the project. Trust becomes bankrupt. People are not able to rally behind the token and get it back up. Or in some cases, it may actually interrupt the functioning of the economy.
Especially when they play to earn game or something like that, where people are actually, relying on the value for sustainability, for revenue, for these things. Let me just briefly say something, and then I want to come back for a second, just so we remember it. One of the things I want to talk to you about soon is different way of looking at the things that are being built on blockchain, different applications. Whereas I feel like until today, predominantly most of the things that are being built on blockchain are DeFi types of projects. Something that's doing something to earn revenue, yield, disrupt a legacy banking thing or something, but there's so much more that can be built on blockchain where decentralization is imperative, that people are using the products not because they're trying to make money, but because it somehow provides a unique value in their life. Like maybe it improves trust amongst an unknown group of actors, or maybe there's an escrow system built in, whatever the case may be. Like it's a value or a service that's being provided where the outcome isn't about getting more rich. It's about just having a really great app that provides value to your life. And so I want to come back to that in a second. I just wanted to mention it. And then I want to just really highlight one thing I wanted to say about the vesting schedules. Essentially, the reason that they're created is to give time for that product to have adoption. And essentially what that means to have adoption is it should reflect the more adoption you have, the more demand that's put on the token. And so a perfect balancing act would be to somehow, if you know that your product is ready and you believe that you have the ability to grow at this rate, then that the vesting schedule for unlocks should reflect and balance with the potential demand, so that you keep this kind of equilibrium for price. There's a lot of sell pressure coming in, but there's a lot of buy pressure from demand for people wanting to use this thing. And I just don't think people understand that. They just don't really know. And certainly from last bull run, there's so many projects that were launching their token without any product anytime soon. And so, when that's the case, how can you even guess what your potential demand is going to be in the next 6, 12, 18, 24 months when you don't even have a product yet, not even an MVP where you can test it out and say, is there demand for this thing or not? And I think that hopefully, the things that we've been investing into recently and a lot of projects I talked to, like, especially that's also what's great about bear markets is that people who are building with the anticipation of trying to have their product ready by the time the next bull run comes around. And, sure, next bull run, we'll probably see a bunch of other projects who are raising money without any product being built. But, I think the first kind of cohort that we see of products coming out in this next bull run are going to be people who have been building for the past 12, 18, 24 months. And they could have some sort of decent assumption of what adoption looks like. And so I just think that this is important for people to understand. Do you agree with that?
Yeah, I fully agree with that. So interesting things are like, there's actually something you can do, right? So to say, I agree that the vesting schedule, the growth in token supply should, in some sense, mirror the growth in the value base, which will be related to user adoption and all that. So even though you have, you may be dealing with a project that doesn't have an MVP or has a very small product, still, there are benchmarks. There are benchmarks when you go and pitch, for an equity fundraise, and the people. There are lots of benchmarks about how quickly a software as a service product, an app, can grow its revenues. You have a sort of range of plausible growth rates, and personally, I'm not convinced. I'm not bought into the idea that building a business in blockchain is going to be exceptional. And I think looking at those typical growth rates for early tech startups are a good sort of place to start. At the very least, they will flag if you're being totally outrageous with the growth in your emission supply. But then the other thing circles back to something I was saying earlier, which is that I think we should move towards contracts where the vesting schedule actually depends on how the business is doing, and that controls the vesting. And not that we just say, okay, we're going to set the vesting on 3 years, and that's that.
That makes a lot of sense for the health and longevity of a project. Do you think, I don't think fair is a good word to use here, but let's just use the word fair, and you can kind of figure out what I mean. Do you think it's fair to investors that in this situation which you're describing, potentially they're getting zero back, right? Which is much more in line with equity investment style, right? And as equity investments, I've got all my things from Coinbase and Kraken and BitFEDX and Bitso and none of them have really materialized, Coinbase, but none of them have really materialized into like tangible liquidity. And that's one of the things I think that those of us who are investing in tokens versus equity, like we don't want to look at equity ever again because of the fact that maybe even if I invest into a project that doesn't make it, maybe that doesn't result in a zero for me. Maybe that results as a negative 50% on investment or something, which is a hell of a lot better than a negative 100% on my investment. And so you have a little bit of ability for liquidity sooner, and potentially to get something back on your investment if things don't work out.
Yeah, you're absolutely right, and that's a key selling point of tokenized fundraising, is that you get access to liquidity earlier, but it doesn't have to be black or white. You can set the dial, you can set the terms so that they fall out somewhere in the middle.
You're right.
And what's crucial, of course, is to be open and transparent of what the terms of the deal are, so that investors can do their diligence and say, is this an asset we want to buy into? Are these terms that we want?
For instance, you could say, okay, well, you're getting it 5% at TGE, and then that's all you're getting until our market cap is $100 million, and then you're going to get your next tranche, and then that's an easier pill to swallow, because I think at the end of the day, most investors are going to look and just say, is there some point where I could potentially, if there's even just only hype and FOMO, can I get my initial investment returned to me? If yes, then okay, let's do this thing, and then I'm happy keeping the rest of it in exponential generational retirement wealth generating types of returns, unicorn or bust.
So, but at the moment, this is a questioning about bargaining power in the market, and the investors have the bargaining power of the terms. So I haven't seen any large move towards this kind of contracting and this kind of thinking. So for the time being, it's the same old way we've been doing it. But I would hope that we start seeing some of these more interesting sort of contract terms. If you think about how equity investors exit on an IPO, they're kind of like they're wedded to the project so much more closely than in a token scenario. They every round they raise, they're kind of like coordinating together with the project owners, and then when they IPO, they do so once the project's sort of like large enough for them to exit, and they can exit, and that doesn't impact the project at all. But also because the equity instrument just isn't a working financial asset in the product or economy like a utility token is. If Elon says something stupid, price goes down, but all the factories are working exactly the same. It doesn't. This goes back to the question again about whether utility. But if you are going to raise with a utility token, okay, well then hopefully let's explore some more controls, and maybe I would hope this change would be led by the biggest investors who are like willing to say, okay, we want to set a different standard here because we see that this unconditional vesting is ultimately hurting our long-term return prospects. Anyway, I don't know. It's just a possibility for the future.
That's a good point. And, some of the things that you were just discussing, I think would be a really nice addition to something that we're working on. I'm not going to say too much about it on this stream because it's quite proprietary at the moment, but essentially it's an attempt, to help us self-regulate in the industry, which I think is critical. And I want to introduce a standard that hopefully everyone calls a gold standard for the way that we look at vesting and ownership of token contracts, and to try to stop some of the abuse that happens between project founders. And I can say for those listening, that there is a really big problem that maybe you're not aware of, and that is these first-time founders who are often quite immature. When in good markets, they get super arrogant, and they start to become, play God mode, where they then become central banks or Federal Reserve of their own economy. And just imagine if you had a bunch of teenagers who were controlling the U.S. dollar. They would just go print more money every time they want a new Lambo, and not think about the consequences that results in for everybody else. The same thing is happening right now with project founders, and when we announced this thing that we're working on, we've been doing research into the top, few hundred cryptocurrency projects and looking at what did they promise publicly? So what's posted on their white paper for their token emissions and their vesting and stuff like that, and seeing which one of them, who of those guys have actually deviated from that public promise. And to me, that's a problem, because people rely on these publicly posted information about, hey, when is the next big unlock coming? When can I expect more inflation? What is a monetary policy? And you can only rely on those if you can trust that they're going to not abuse that power.
I'm really happy you're working on that. That's actually something that I also think is really important, and actually I struggle with, because I don't know if you've seen this, but people erase all of the information of their initial offerings quite frequently.
Mm-hmm.
And you don't know what the terms were. There's sort of like, and there's some party sites like ICO Drops, Crypto Rank, and then they have sort of like, sometimes you'll find some spotty PDFs or JPEG grabs, but it's so spotty and unreliable. And you're like, I don't know what people actually went to market promising. I going back to what I said earlier, I don't think it's a bad thing if people change, as long as they're upfront to their users saying, we're making changes because of XYZ, and we're fully including you on that. But yeah, if they're doing it behind closed doors, then that's no good. I would love to see, in the same way that companies are forced to have audited accounts, I think we need sort of reporting standards for data and disclosures, and some of this stuff should be written to the blockchain. There should be like certain standards and formats so those records exist and they can be queried and analyzed. So yeah, this is a problem. It's ironic, right? We have this amazing data transparency tool, but we're not using it to its full potential by any means. And
Yeah, exactly.
You aspiring to define a standard is super important, because it's once something becomes a standard that it becomes valuable, because everyone uses it. It becomes common language, and then it just massively increases efficiency around these tasks.
Yeah, whenever I think about what we're doing, it just makes so much sense, and it's really a win-win for everybody, kind of involved. Yeah, so I think this is a pretty good 101 session. I think that we can build
101 and then some, Kyle.
Yeah, definitely 101 and then some for sure. I think that it covers a lot of things that people can be aware of, that they can learn from. And I think that there's so much more that we can get into. We haven't even touched on things like incentive mechanisms, reward schemes, real APY versus bullshit APY, all these different things, governance and DAOs, and what constitutes good utility and what doesn't constitute good utility. And then one of the things that I struggle with, which I'm looking for someone to provide a good argument against my case, is a circular closed loop token economy like really the only way to really do token economics, which in my mind, it should be. But I do understand at the same time how, let's say that, American Airlines wanted to put their point system into a crypto token that was a rewards token, and that was really its only purpose. You're looking at a different type of assumption, a different type of modeling for something like that, where to perceive value. But I think for at least a lot of the people who are proposing that they're disrupting some incumbent by some decentralized alternative that's a superior product, you're not going to have the best design unless you have a closed loop circular token economy, because you stand to be disrupted by somebody else, and so this is one of the things that I really would like to talk to you about also, and see if you can provide some good arguments, why maybe it is not the be all end all,
Yeah, that came up on a different call with you. I'd be happy to discuss that. Absolutely. Yeah. Really enjoyed this, Kyle. Thank you.
Yeah, for sure. Okay, man. Thank you. And anyone, Rodrigo, I call him Rodrigo, this is Roderick here, but we go back as friends. But anyone who wants to learn more about token economics, Rodrigo has a channel. It's called what? Token Design?
Token Design, that's right.
Token Design. And yeah, Rodrigo has been doing really great models. He does a lot of our modeling, or all of them pretty much. And thanks for coming on.
Pleasure. Thank you for having me on here, Kyle.
Cheers. Bye-bye.
See you next time. Bye-bye.